As Bob mentioned, my name is Caitlin Mariano, and I'm a tax partner with Bob at Danville McKee. A quick introduction of what we'll be covering today. So the purpose of our presentation is to give you a clear overview of accounting practices specific to contractors. We're hoping to give you some tools to help you with accurate job costing, revenue recognition, and strengthen communication between your accounting and project management team. Why does that matter? Construction projects are complex and long-term, so they require long time detailed tracking for accurate financial support, cash flow, compliance, and profitability. And we're hoping to help prevent misstatements in revenue, costs, and job performance. A quick agenda of what we'll be covering today. So I'm going to be going through some tax accounting methods available for contractors. I'm going to highlight some tax depreciation changes for 2025 and get into some notable impacts of the One Big Beautiful Bill Act on the construction industry. Then we'll transition to Bob's portion of the presentation where he's going to go over some industry-specific accounting principles, contract types, job costing fundamentals, understanding and analyzing WIP schedules. And then if the time is allotted, we'll get into some internal controls and best practices and audit automation.
And this presentation is going to be provided to everybody, so you don't have to worry if we get to anything or you want to go back and look at some of the slides again. Everyone's going to receive a copy of the presentation along with a recording of the webinar in your email at the end of today's session.
Yes, and I did start our first polling question. So the question is, what is your role at your current company? The options are you an owner, member, shareholder, are you controller, CFO, accounting manager, president, CEO, or other? And again, we have a countdown, about 10 seconds left. There's a QR code on the slide if you are having issues accessing it. Our team is on standby, so please reach out.
And again, we'll say it one more time, and again, a couple times periodically, you need to answer the polling questions in order to get your CE credit for today's session.
All right, and the results are in. So it looks like the majority of those attending are in the management roles. And now I'm going to go through some tax accounting methods for contractors. So Internal Revenue Code Section 460. This code section targets the construction industry. It requires contractors to utilize the percentage of completion method when accounting for long-term contracts for federal income tax purposes. There are two exceptions to that, being home construction contracts and the small contractor exception. Of note, one of those exceptions, the home construction contract, was changed in the One Big Beautiful Bill Act. The first exception is the home construction contract. What that is it's a contract where 80% or more of the estimated total costs are reasonably attributable to the building, construction, reconstruction, or rehabilitation of dwelling units. And it specifically was related to buildings with 4 or fewer dwelling units with an anticipated completion date of 2 years or less. Any contractor meeting this criteria was exempt from utilizing the percentage of completion method for accounting for those contracts. And again, that has been changed under the One Big Beautiful Bill Act. These rules have been expanded. So now it is considered for a residential construction contract. Anyone that is entered after July 4th of 2025, they would now qualify for this exception. So the big things of note here are that there's an increase in the number of dwelling units that are available. And again, that project can now be completed within 3 years. So this is important to note for apartment buildings, townhouses, mixed-use development properties. Anything now, again, with an increased number of dwelling units can fall under this exception. The other exception is the small contractor exception. So a small contractor is defined as a business that meets the gross receipts test for an applicable tax year. The gross receipts test is used for a variety of limitations throughout the tax law, and you'll see later I'll refer back to it. But what it is we're looking at the average annual taxable gross receipts for a business for the last 3 tax periods. If that average does not exceed a set threshold, then they would qualify as a small contractor, and they could utilize some of the methods that I'll be going into for accounting their long-term contracts for tax purposes. If they're above that threshold, then they're considered a large contractor and they're required to use a percentage of completion unless they are considered meet the other exception I just covered. For 2025, that average annual basis is set at 31 million. So some definitions, a long-term contract for federal income tax purposes is defined as a contract that spans more than one tax year. So if you had a contract that started at the end of one year and in length of duration ended in a true, 10 months, but it started in one year and ended in the following tax year, it would still be considered a long-term contract for tax purposes. A small contractor, as we just went through, is defined as a business that meets the gross receipts test for the applicable year. And that is, again, subject to inflation on an annual basis. A large contractor is a business that does not meet that exception under Internal Revenue Code 460. So some accounting methods for long-term contracts include percentage of completion, completed contract, accrual less retainage, and then there are some additional tax deferral items available to contractors that I'll be going through for you. So percentage of completion method, again, this is the method of accounting that's required for large contractors. Under this method, revenue and expenses are recognized based on a percentage of completion ratio, which is determined by dividing the total cost to date on a contract over the total estimated cost of the project. Again, this method is required for federal income tax purposes for the large contractors, and it is the required method for those taxpayers that are subject to alternative minimum tax. On the slides, I have a quick example of how you would utilize the percentage of completion method. So looking at this contract, we have a $1.2 million contract with total costs estimated at $800,000 with $200,000 of costs absorbed to date. So based on those numbers, we have a percentage of completion of 25%. If this was the method of accounting for this taxpayer, they would recognize revenue of $300,000, costs of $200,000, resulting in a gross profit of $100,000 for the year. Another method of accounting that we have is completed contract method. Under this method, revenue and expenses are completed when a contract is considered complete. The contract is considered complete once 95% or more of the contract costs have been incurred and the property is in the hands of the customer. They have use of the property. This method allows taxpayers to defer revenue recognition until the contract is complete, and it is available to small contractors. So in this example, we have the same contract that we just walked through under percentage of completion, 1.2 million of a total projected revenue cost. The costs are projected at 800,000, and to date, they've only incurred 200,000 of costs. Same percentage of completion, 25%. However, since we're using the completed contract method, that's less than 95% complete. So at the end of the year, for tax purposes, the gross profit recognized would be zero. Another method available is the accrual less retainage method. A retainage is defined as a percentage of billings for services performed that are withheld by the customer until complete. A contractor can establish a method of accounting where they could exclude both retainage receivables and payables from accrual basis income until it is truly received or paid. Large contractors who do not meet the gross receipts test can utilize this method for short-term contracts. And here I have an example of how this method would work. So there's 4 contracts. One noted as a long-term contract with an uncollected retainage of $5,000 and 3 short-term contracts. The total uncollected retainage at the end of the year is $21,000. Under the accrual less retainage method, a taxpayer could exclude $21,000 in total if they meet that small contractor exemption. If they do not, and if they're a large contractor, we would just be looking at the short-term contracts, and that would allow them to exclude the retainage of $16,000. Some additional tax deferral items relating to contractors. There's the 10% elective deferral. This method is available for all contractors. If a contractor has jobs that have not reached 10% complete by the end of the year, they can defer recognition of that gross profit. Another method would be non-long-term contract deferral. A non-long-term contract is a short-term contract. On those jobs, contractors could defer the over and under billings related to those short-term contracts. So a short-term contract is one that does not span more than one tax year. And because of that, they do not, if you are a large contractor, they would not be subject to the requirement of percentage of completion. Some methods available include the cash basis method of accounting, accrual basis, and accrual less retentions. Under the cash basis method, revenue expenses would be recognized as the cash is collected and or paid. And under the accrual basis method, revenue expenses are recognized as progress billings are made and job costs are incurred. So under this method, taxable income would go up if there are overbillings on the WIP schedule, and it would go down if there are underbillings. So sometimes that's a planning strategy for some of our clients. They will look to hold on billings in efforts to have, a decrease in taxable income. So now I'm going to get into some depreciation changes for 2025. Section 179 allows businesses to immediately expense the cost of qualified property that's placed in service during the tax year. We saw some large changes to this limit under the One Big Beautiful Bill Act. So before the bill was passed, the expensing limit for 2025 was set at $1,250,000. That's up from $1,220,000 in 2024, with a phase-out threshold of $3,130,000. Again, that's up from the prior year. With the passing of the bill, the expensing limit for 2025 is now set at $2.5 million. And the phase-out threshold was increased to $4 million. So there is a cap on 179 expense being an expensing limit. Anything above that can be carried over, and the investment phase-out threshold is there. So if you have equipment placed in service over that amount during the tax year, that cap does get phased down. So if you had $4,050,000 of eligible property for 179 that was placed in service during a tax year, you would see a decrease in the max amount of 179 you could take for that year. Another major change that we saw was related to bonus depreciation. So bonus depreciation allows a business to expense a fixed percentage of a property's cost. We had been seeing a scale in that percentage over the last few years. So in 2024, that was set at 60%. And for 2025, it was set to be at 40% of the property's cost. Once the One Big Beautiful Bill Act was passed, that 100% bonus depreciation amount was restored. And that's for property that's been placed in service after January 19th, 2025. The One Big Beautiful Bill Act did introduce a new Internal Revenue Code section 168N. This section provides certain qualified non-residential real estate used in the manufacturing product process or production process full expensing. That construction must begin after January 19th, 2025 and be completed and placed in service by December 31st of 2030. To be eligible, that property must be subject to depreciation under Internal Revenue Code section 168. It must be used by the taxpayer in an integral part of qualified production activity, must be located in the United States or any US possession, and the original use does have to commence with the taxpayer. Any property that is qualifying for this exemption and utilizing it is subject to a 10-year recapture period. So on the slides, we have a nice chart that kind of compares some of the depreciation methods I just covered. Of note, section 179 has an annual limit, bonus depreciation does not. And then all the way to the right, we have some just traditional depreciation. Other things to note, bonus depreciation is automatic unless the taxpayer elects out. Bonus depreciation can be taken and create a loss. So the income limit is set for 179. So if you have a loss for the current year, 179 cannot be taken, but it can be carried forward. However, bonus depreciation can be taken in years of a loss and they can create a loss. Other items of note, companies that have a lot of vehicles, there is a vehicle limit of 179 expense, but bonus depreciation does not have an SUV, heavy vehicle dollar cap. And this slide does not reflect the updated 179 amount, but again, that was 2.5 million for 2025. And bonus depreciation is set at 100%. So these are key things to keep in mind with year-end tax planning. They're great tools to help manage and control expenses and help, create a loss if needed. Now we're going to go into our next polling question. Do you think that the One Big Beautiful Bill Act will impact your company in a positive way? Yes, no, or maybe you haven't heard of it yet, but this is your first year hearing of it. I know we've heard and talked about it a lot in our world, so.
Yeah, and there's a lot of information to take in there from everything Caitlin's gone over so far. We do see the questions popping up in the chat, but just bear with us in the essence of time. We're going to try to focus on, our session for now, and we'll go back and recap to some of the questions if we have time, or we'll respond to you after the webinar if you've left your contact information for us to do that.
Sorry, technical difficulties over here. We'll be starting the second polling question again, so you have 40 seconds. For anyone who missed it, you're in luck. The QR code is available.
Just a few more seconds here. Make sure everyone gets your answers in now. We want to get you the CE credit.
As much as I'm sure you love hearing us talk, there's 5 seconds left. Right. Majority of you say yes. So,
Yeah.
nice.
Nice. Everyone's heard of it.
Yeah, everyone's heard of it. There you go. Okay, so now I'm going to get into some other notable impacts of the One Big Beautiful Bill Act, specifically targeting the construction industry. So one item of note is that the Section 179D deduction has been repealed. So that deduction provides a tax deduction for energy efficient commercial buildings located in the United States. It's subject to a deduction limit, which is calculated based on an energy savings per square foot calculation. It's allowed for the year that the property is placed in service. So this deduction will expire for construction beginning after June 30th, 2026. We've also seen the repeal of the Section 45L credit. So this was a credit that came, that was revamped under the Inflation Reduction Act of 2022. It's also referred to as the 45L credit. It provides a credit, a maximum amount up to $5,000 per dwelling unit for homes located in the United States that meet specific energy savings requirements. This credit is available to contractors that meet, again, another slew of requirements under the code section 45L. The One Big Beautiful Bill Act has terminated this credit for homes acquired after June 30th, 2026. We saw a change to the Section 163J. This is a limitation on business interest expense. This was first introduced and enacted in 2017 under the Tax Cuts and Jobs Act. The 163J limits deductible business interest expense of 30% of adjusted taxable income for businesses that do not meet that small business exception, that gross receipts test that I covered earlier on. So here's another code section that is looking at the gross receipts of a business to determine if they're a small or large business. Again, what that would mean is anyone who's in that small business exception, they would not be subject to this requirement, but anyone above it, they would be limited to their interest expense deduction potentially if it exceeds 30% of their adjusted taxable income. So the One Big Beautiful Bill Act, this did restore and make permanent the computation of adjusted taxable income. For tax years beginning after 2021, we saw a change in how adjusted taxable income was calculated. What the One Big Beautiful Bill Act did reintroduce is that the basis for computing adjusted taxable income has been reinstated to reflect earnings before interest, taxes, depreciation, and amortization. This can be major for some clients if they have those large expenses of depreciation and amortization, those are now added back, which would again adjust, if you have adjusted taxable income and you're adding back those expenses, it would increase your adjusted taxable income potentially, which would allow a larger portion of business interest expense to be deducted. Another item of note is for tax years beginning after December 31st of 2025. The limitations of 163J are extended to interest that is required to be capitalized. So that used to be a planning point for some clients. If they met the requirements of capitalizing business interest, that interest was separately accounted for and not subject to the limits of 163J. But the bill did mandate that any business interest expense, including capitalized interest, will remain subject to the 163J limitations for large taxpayers. So again, if that was a former planning point where you had the ability to capitalize some of that business interest expense and avoid those limitations, starting in 2026, all interest expense is going to be looked at when determining the 163J limitation. Internal Revenue Code Section 199A, the qualified business income deduction has been made permanent. So that was first introduced by the Tax Cuts and Jobs Act in 2017 and it was set to sunset in December 31st of 2025. This allows for a deduction of up to 20% of qualified business income for partnerships, S corps, sole proprietorships. And the One Big Beautiful Bill Act did make this deduction permanent. Internal Revenue Code Section 461L. This is the excess business loss limitations. Those were made permanent as well by the One Big Beautiful Bill Act. Another TCJA item was scheduled to sunset after 2025. It was prolonged with the Inflation Protection Act of 22 through 2028, and now it has been made permanent. What this provision does is that it disallows excess business losses of non-corporate taxpayers if the amount exceeds an inflation-adjusted annual threshold. So for 2025, the thresholds are for single taxpayers, $313,000, and for married couples filing jointly, it's $626,000. So again, what that means is if an individual taxpayer has business losses that exceed more than these thresholds, looking at their filing status, they would not be allowed to deduct those losses. So they'd be capped at those thresholds, and any amount above and beyond that would be carried forward to the following tax year and treated as a net operating loss for future use. Some of the other items of note that came out of the One Big Beautiful Bill Act would be the SALT cap limitations. So the TCJA in 2017 imposed a cap on the state and local income tax deduction for individuals to $10,000. That was scheduled to sunset at the end of this year. The One Big Beautiful Bill Act has increased that to $40,000, and that's set to sunset in 2030. Those amounts are subject to annual inflation adjustments, and there is a phase out for high income taxpayers. So if your adjusted gross income is more than $500,000, you would be scaled back on your SALT cap deduction nowhere below the $10,000. So if you're above that $500,000, the most you'd be scaled back for SALT cap limitation would be $10,000. In response to the state and local income tax deduction, several states, including New York State, implemented past serenity tax programs, and those were not impacted by the One Big Beautiful Bill Act.
All right. Thanks, Caitlin. That was a lot of information there. So I just keep in mind, again, the presentation is going to be provided to everyone after the session is over, along with a recording. Caitlin's information is listed in the presentation as well. So if you have any specific questions about how this relates to you individually or to your company, feel free to reach out to her via email. And again, I'm Bob Reeves. I'm an audit partner at Danville and McKee. We're going to get into now the financial reporting and bookkeeping side of things. And I wanted to step back and, kind of take a high level overview of why this is so important. The construction industry has the second highest failure rate. Restaurants still continue to hold that top spot, but to understand where third parties are coming from, whether it be surety, insurance, your lenders, this is why some of this is so critical. It's a high risk industry, and it's all driven on estimates. So what we're going to go over in the next few slides is really some controls and practices you should put in place to make sure that you have accurate estimates. I'm sure everyone out there in the webinar right now, who all, the majority of it was CFOs, controllers, and management positions, know, it only takes a bad job or two to really change things drastically for the financial performance of a company. And hopefully going over, some of these next slides, we can give you some tips and best practices to have the best estimates you can in your financial statements and your work in process schedules, so everything is accurately reflected, to the third parties you're presenting them to. So here's the overall hierarchy of construction. You start with your owners, you have construction managers, some general contractors. From there, other services might be subcontracted out, whether it be electrical, HVAC, or other work. So here we go into the industry-specific accounting principles. So revenue is recognized when contracts are involved based on the ASC 606. This is a principle that came out several years ago at this point. It should have been fully adopted, by all private and public companies at this point. Everyone should be using it to recognize revenue on contracts. There's really no exceptions to it at this point. The core principle behind ASC 606 is that an entity shall recognize revenue to depict the transfer of goods or service to the customer. When does control is the key word here. When does control transfer over to the customer? And then you should be recognizing that revenue in an amount that reflects the consideration that the entity receives or expects to receive in exchange for those goods or services provided, which in essence is typically always going to be the contract value. This is going to affect the revenue timing, contract assets, and liabilities that you have while the jobs are in progress. And it's also going to affect the disclosures in your financial statements. And the common mistakes that, we generally see is, people not disaggregating revenue correctly, meaning if your company is providing different services, like you're doing build services as well as architectural engineer design work, maybe you're providing some other services, you're supposed to disaggregate the revenue in your financial statements. The other thing, really, it's going to impact the contract assets and liabilities, and also the timing of your revenue recognition if ASC 606 is not properly followed. So here are the 5 steps used to apply the core principle. First, you have to identify the existence of a contract. Is there a contract with a customer? Step 1. The answer to that is yes. You go right through the rest of it here then. Identify the performance obligations in the contract. Is there multiple performance obligations? Is it design work and build work, or is it just one item that you're doing? You want to determine the transaction price, allocate the transaction price to the performance obligations, and then you're going to recognize revenue when or as your company satisfies those performance obligations. And I'll go through this in an example on this next slide. You identify a contract with a customer. It's a $5 million design build agreement. Well, there's the contract. We've identified it. It exists. Now we're going to identify the performance obligations in the contract. Is it going to be one single project that we're considering it to be? Or are there multiple obligations? Is the design portion, can that be allocated a price of maybe $1 million? And then the build portion of the contract is, going to be allocated $4 million. This is all kind of stuff that you would determine when you're looking at your performance obligations in the contract and when they're going to be satisfied. From there, you then determine the transaction price, and you're going to allocate the transaction price to the performance obligations as, control is transferred to the company. So in the case we just used as an example, the design work is probably going to be 100% completed before the build work is. You would have those as 2 separate line items on your work in process schedule, showing, how the percentage of completion is being recognized based on those 2 performance obligations. So as I mentioned, revenue is recognized as performance obligations are satisfied, which can occur over time or at a point in time. One of the following criteria must be met to use the overtime recognition. That's that the customer is receiving and consuming the benefits as the work is being performed. Control of the asset is transferred as it's created. and the, or the asset has no alternative use to the company that's performing the work. And, the contractor has an enforceable right to payment for the work as it is completed to date. And when you're recognizing revenue over time, GAAP and FASB call it recognizing revenue over time. Previously, it was always referred to as percentage of completion. It's the same formula. Percentage of completion is your total cost to date over your total estimated cost. That is the percent that you are done with the contract. You're going to multiply that percentage by the total contract value, or by the value that you've allocated to the individual performance obligations within one contract. That's going to be the revenue that you recognize at that point in time. Under ASC 606, you are supposed to account for future losses immediately as they are known. As soon as there is a loss in your estimated gross profit for the job, you should record a loss provision, and that should be reflected on your financial statements. Loss provision is going to be, when your total estimated costs exceed the total contract value. And again, this should be monitored through monthly work in process updates. WIP is work in process, job cost to complete reviews, and regular gross profit trend analysis. It's very important to be accurately and consistently looking at your work in process schedule and monitoring your jobs. And as soon as you think items are reasonably estimable, putting them into that schedule to accurately reflect it, including estimated losses on jobs. Here's one of our polling questions. How many steps are there to apply the core principle of ASC 606? I'll give everyone a few moments to answer that. Make sure you do so you get the CE credit, and then continue on. So again, how many steps are there to apply the core principle of ASC 606, the 5-step methodology that we just walked through? A little bit of a hint there. All right, good. Yeah, so again, 5 steps. And as if there's ever a contract with a customer, just make sure you're going through that criteria. And that's really going to be your blueprint of how revenue should be recognized for the contracts that you have with your customers. So we're going to take a minute and go through the different types of contracts. You have fixed price contracts where a contractor agrees to deliver the project for a set price. Revenue is recognized again using the percentage of completion method, which again now referred to as recognition over time under ASC 606. But if you have a fixed price contract and control is transferred to the customer throughout the process, you would use the percentage of completion method that we just went over before. Cost plus contracts, typically when the customer reimburses for actual costs plus a fixed fee, which could be based on a percentage or a fixed dollar amount. Again, revenue is generally recognized over time. You're going to use your cost to cost input, comparing that to total cost or total expected costs on the job. And then you also have time and material contracts where the contractor will bill for labor hours and materials used. Revenue typically, again, is recognized as control is transferred to the customer. So common theme here between everything, it's when control is transferred to your customer, that's when the obligation has been satisfied, which again can be at one point in time or it could be over time. Job costing fundamentals. So you have several different costing methods and methodologies when going through costs for contractors. You have your direct costs, which are directly traceable to a specific job. Typically, it's going to include your labor, materials, subcontractors, equipment rentals, items of that nature. You also have indirect costs, right? Costs that aren't tied to one specific job, but maybe they support all projects. This could be supervisor time, equipment maintenance, job site trailers or tools that are transported around multiple jobs at a company. These costs are shared. They should be shared across jobs and should be taking the total cost and proportionately allocating it, to all your contracts so that each job, absorbs their respective portion that they should, for these types of indirect costs. And additionally, most of the accounting softwares at this point used by contractors have cost codes that you can track. Cost codes break down, the project expenses by category and phase. Sometimes it'll even break it out, the labor based on the type of labor or, whatever type of work they're doing, to capture the right rates that you might be using if you are involved in collective bargaining agreements or using union employees. Overhead allocated to jobs to capture the full cost burden. And doing it this way really helps you analyze kind of on a micro level, like all the budgeted details and tracking information that help flow into your overall financial analysis. So you can understand where your estimates are maybe a little off, whether it's off in a positive way or a negative way. You can really, using this method and using these softwares, kind of drill down, to where your cost overruns are, or, to just compare to your budget and see how reasonable your estimates were. Because again, as we mentioned before, construction industry being the second highest riskiest industry there is out there, it's because a lot of risk is involved. Everything is all estimated going into the jobs, to a certain extent, and you can mitigate the risk to a certain extent, but you're never going to be able to eliminate it 100%. Using these types of tools can help you mitigate it to the best of your ability. And then you should have an overhead allocation on your jobs as well. This is representing general business expenses that they're not directly tied to a single job. Your office rent, admin salaries, insurance costs. Again, they should be allocated across all jobs to reflect the full cost of operations. Simply put, you would take a percentage of overhead and allocate that to your costs on your WIP schedule. So now we're going to walk through some examples of a WIP schedule and kind of how it's analyzed by third parties, so you can kind of get a good feel for what they're looking for and how you can make yours look as beneficial as possible, to accurately reflect your company's health. So here's a bit of an overview on the work in progress schedule. It's a report that tracks the financial status of ongoing jobs and also jobs that have been completed during the year, and it compares what's been earned versus what's been billed on each project. It highlights whether a job is overbilled, whether you've billed more to your customer than you've earned, or whether you're underbilled, whether you performed more work and have not yet sent out your most recent progress bill or final billing, to your customer. This helps assess the cash flow of the company, the billing accuracy, and the overall project health of the individual jobs on the work in process schedule. It's going to ensure that revenue and profit are recognized based on the project progressing, when control is transferred to the customer, and providing the insight needed, for accurate forecasting, job management, and financial planning. So the components of a WIP schedule, and I'm not going to go through every item here because we'll go through them in the next slides. I'll show you some example. But any work that's started but has not yet been completed by the end of an accounting period is required to be presented. There's no universally accepted format to present a WIP schedule, but it should include at a minimum the following information, which are pretty self-explanatory. And again, we'll go through them in more detail in the subsequent slides, but it's going to be presenting your contract value, the estimated cost to complete the project, and your estimated gross profit. From there, you're going to go into what your current period revenue, current period cost, and current period gross profit was. You're going to show revenue and costs recognized to date on the job. So that way, whoever's reading it can see how much work, revenue, and cost there still are left to recognize. And you're going to show them percentage of work completed and the revenue that you've billed to date. So here's the components of a WIP schedule. I hope everyone can see this all right. But it's got all those categories I just kind of pointed out. And again, we'll go through each one in a little more detail here. But this is kind of a high level overview of what it would look like. You have your jobs over in the left-hand column, far left under contracts. And then it's going to take you through all the criteria, that I just mentioned, and then some. So your contract price. The contract price is going to be your original contract price that you entered into. And again, you should always be updating it based on, management's best estimates at that time. If there were change orders, they should then be included in there. If there's been any claims or liquidating damages should be in there. If there's an early completion bonus and management thinks they're gonna get it, that should be included in the total contract revenue. And that can be included from the beginning if you think you're gonna get the job, or if you think you're gonna get those type of bonuses, if you're sure or certain, that you're more likely than not to get it. There's nothing wrong with including that upfront in the revenue contract amount that you're showing, or if you're unsure, be conservative. And then when you get to a point in time where you're gonna get the bonus, it can then, go into the contract value that you're reflecting. But you always want to be changing that target. And it's the same with the estimated cost of revenue too. That should be a moving target. Your estimated cost of total revenue to complete the job should not be the original number you started with. It should be constantly revised for any overruns on labor. If something happens with a subcontractor, there's additional costs that should go into there. And again, if it gets to the point where your estimated gross profit's going to be a loss, then you would have to accrue that upfront. But your total estimated cost to complete should be reflected as the job progresses, again, through monthly monitoring of the work in process schedule, if not more frequently. And there's your estimated gross profit. It's obviously just the contract price minus your estimated costs of completion. Again, a full loss must be recognized as soon as it's identified. Whoever's reviewing your work in process schedule is really going to look at the gross profit to track historical trends and reveal the accuracy of your cost estimates. If they see, a lot of cost overruns run, during the last 10% of completion of the jobs, they might not have a lot of faith in management's estimates that, the job waits until it's 90% completed, showing a certain profit margin. And then all of a sudden at the last 10%, it ends up being a loss or the margin decreases, significantly. They're going to look at the historical trends here on your past year's work in process schedules, and they're going to track your jobs that are in process and look at how they end up completing when all is said and done. Job totals to date should be the revenue earned, recognized to date, and it should be your total actual expenses incurred to date as well. And then you want to show them your billings to date, what you've actually billed the client so far on the job. And that would include conditional retainage too. You've billed it, it's just that contractually, your customer is not required to pay a certain percentage of it if there is retention. It would just be paid upon job completion once all of the criteria has been met. So now you go into some balance sheet items. These are part of the contract assets and contract liabilities I mentioned before, and something that, the users of your financial statements are really going to pay a lot of attention to. You have your cost in excess of billings, commonly referred to as underbilling. This is reported as a current asset on the balance sheet, and it's typically going to be labeled as a contract asset. And it represents revenue that you've earned in excess of the amounts you've billed to date. So you've earned the revenue, you just have not billed your customer for it yet. Even though it goes on as an asset on your books, this can raise some questions if certain jobs are really underbilled about why a bill hasn't gone off. So even though this is an asset, this will be scrutinized by your lenders, by sureties, other insurance companies, as to why these amounts haven't been billed to the customer. Then similarly, you have billings in excess or an overbilling. This is going to be a current liability. This represents that you've billed your customer more than the revenue you've earned. Maybe you bill them 10% upfront. Even though you're 3% done, that would be an overbilling and reported as a contract liability until you progress to the percentage of work complete that you could have billed them for, and then you would offset it against the liability. On the WIP schedule, you also want to show job totals year to date. So that's going to just show the year to date revenue, cost of revenue, and the gross profit or loss for the period, kind of like we talked about before. So you're showing them, the information on your job to date performance, and you're showing them how that is reflected in the year to date performance of the company. Other components that might be analyzed through your WIP schedule is backlog, which again, just taking the contract value less revenue recognized to date. Sometimes they might also look at the estimated gross profit less the gross profit to date. Accrued losses, again, you should recognize a loss on a contract when it's estimated that the costs exceed the total contract revenue, and you're going to do that immediately when that becomes management's estimate that the job is going to lose money. Again, kind of just at a high level here, here's the different components of the WIP schedule. Again, this will be provided in the presentation that's sent to everyone at the end of the webinar. And again, there's your backlog. Look at the total contract price, less the revenue that's been earned from inception to date on the jobs. That's the remaining work that, the company still has to complete that they're liable for with their customers. Again, we kind of went over this in more detail in the previous slides, but to recap the high risk areas, your estimated cost to complete, allocating company overhead to the jobs. Are the profit margins exaggerated? Is there a weakness in management's ability to monitor field work as the job progresses? And that therefore is leading to a weakness in the estimated cost to complete, that management is reflecting on their WIP schedule. Well, are there warranties? Are there contingencies on the contract? Could the job be 100% complete, but the company is still on the hook for going out and performing punch list items, at their own cost with no additional revenue coming in to support it? And if the job is already on a little bit of a thin margin, how is that going to impact it? Again, like those costs should go into the estimated cost to complete. So if you have to show that it's not done because there's more warranty work, you have to go out there that it's going to be completed and how it's going to impact the job. And change order tracking. A lot of times there's change orders. They can sometimes take a while to become approved by the customer. You just want to make sure that the change order tracking is accurate and that management's comfortable with it, how it's going to impact the contract value, how it's going to impact the total estimated cost to complete. So some financial statement red flags, on the balance sheet, do you have a high accounts receivable? Is that going to cause concerns about cash flow or collection issues? Again, unbilled revenue, that contract asset that we talked about, costs in excess of estimated earnings on uncompleted contracts. A high amount there may be, indicative that there's poor billing practices at the company, that there's delays in customer approval, and that's why they're not paying it, that, some of these cost overruns are being disputed by the client and, they're not going to be willing to pay it. And what was presented as a potential asset is just going to become, additional costs on the book and lead to poorer performance in the job than what has been presented. And naturally you have a potential collection risk, because to a certain extent, your unbilled revenue is stuff you still have to receive from your client. And then overbillings. High overbillings, generally aren't a good thing either. It's great that you collect the money up front from the customer, but it's still a liability to the company. You can't spend that cash on another job or use your discretion on what it's for. If a customer has given you that money and you're liable because you haven't performed the services to earn it yet, you need to have that cash on hand until you start spending it on the costs that are associated with the contract that the overbillings are related to. And if you have a high overbilling amount across all jobs, sometimes, your lenders, bonding companies, they'll look at how much cash is on hand. And if they don't see it there, then they know the money has already been spent, and that the company has a liability on its book to its customers, but doesn't have the asset there, to potentially perform the work, which again can cause questions. And on the income statement, again, some red flags would just be like revenue recognition not being properly followed by ASC 606. And then the gross profit, again, they're going to notice unexpected swings in job performance, and it's going to lead them to believe that maybe there's poor estimating, change orders aren't properly accounted for. You don't want them to lose faith in management's ability to estimate their jobs. You want to make sure your work in process schedule is a moving target as the job progresses, and you're accurately reflecting, the cost and the change in contract value as you go. Again, I'm going to kind of rip through this because I think we covered a lot of it in more detail, but some red flags that will concern lenders, auditors, sureties, large unexplained swings in WIP, jobs with consistent profit fate. Their gross profit percentage consistently drops over time every time you give them a new WIP schedule. Negative WIP adjustments that happen late in the project life cycle. They're, unless something unexplained or unplanned pops up, they're going to know that potentially there were costs in here, that management knew there would be overruns, and it just was never updated in the estimated cost to complete. And then a high unbilled revenue without timely billing follow-up, they're going to pay attention to the cash flow because that's how everyone else gets paid, right? The company gets the cash in from their customers, and then they can pay, the lenders, auditors, the sureties that have been helping out. To help them obtain the job. So disciplined reconciliation between the WIP schedule and your backlog will ensure consistency in reported financials, supports strategic forecasting, and it gives everyone the faith, for them to rely on the schedules they're looking at and be comfortable with them, which will hopefully help, your continued relationships with your lenders, auditors, and sureties in the future. So we have our last polling question here. Does your company use a WIP schedule to track the progress of long-term jobs? And I would go a step further and say, does your company use a WIP schedule to track the progress of jobs in general, even if they are short-term jobs? If you're monitoring everything on a monthly basis, unless it's a job that's turning around in a couple days or weeks, those should go on the schedule as well. So I'll give everyone a few more seconds here to answer that. This is the last polling question for your full CE credit. All right, 89% yes, so that's good. And again, everyone who answered no, you have our contact information. If you need any help setting up a WIP schedule, advice, tips, guidance, please feel free to reach out to us. We're happy to help, so that way you can get everything in good standing and have a confident, supporting set of financial statements to help you go around and obtain the contracts you want, so your company can perform the work. So we have a few slides here, and due to the time we have left, I'm not going to go over these. But again, this will be provided to everyone. Just goes over some internal controls and best practices, items you can use, to again just have reliable financial reporting, the safeguarding of your company assets, a good control environment, risk assessment, activities in place that control the company, and monitor it properly. We have some critical controls in the construction environment. This is all good stuff that you can read on your own. And again, automation is a big thing we're seeing now with the development of the technology, not just AI, but just the tools are involved. A lot of the machinery and equipment now can have their own electronic tools and systems that can streamline all these audit processes and reduce the manual work. A lot of places will have employee IDs. The employee gets on a machine, they type in their ID, that automatically can now track the amount of time that employee spent on that machine and what job they were working on, and what the expenses incurred should be, and putting it directly back into the company's accounting system using those cost codes that we talked about earlier. So there's a lot of really cool automation stuff out there that increases the efficiency and the audits and management's, reconciliation of monthly activity. It absolutely improves the accuracy and consistency, and it can really help you gain a competitive advantage, because if you're not stuck in the details of reconciling all that information out on a monthly basis, it just helps you at the management level focus on how you're going to grow the company, how you're going to obtain more work, and how you're going to continue, to run your business. So again, sorry we didn't have any time to answer questions. We'll be reaching out to everyone separately, assuming we have your information there to do so. We appreciate everyone's time today. Again, I'm Bob Reeves.
And I'm Caitlin Mariano, and, we hope we left you with some, useful information in helping present your financial information in a clean manner, but also some planning points to highlight the changes that are coming underway with the One Big Beautiful Bill. And if we did not get your questions, as Bob said, we do have, the ability to reach out to you afterwards. If you have any questions on things we covered or did not cover, certainly reach out to us.
Yeah, and don't forget to check out before you leave. Thanks, everyone.
Thank you.